Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seamer interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seamer.
Welcome everybody back. Another episode of the Apartment Guys podcast. And this is a special episode with Mr. Paul Winterowd of Bonneville Multifamily Capital, rather. And this is going to be basically our part of our expert series, where Paul is a mortgage rep. And it is so much more than that, a wealth advisor and a lot of other things, but basically facilitates the getting of the loan process and buying apartment buildings. And so we wanted to have Paul on today to basically talk about getting game ready for buying an apartment asset, complex or building, whatever it is, and what it takes to get a loan closed. So, Paul, welcome. Really glad to have you.
Yeah, Tate, it's great to be back and to wrap with you here for a minute. I'm excited to jump in here.
Yeah, it's. I think you were on episode in episode 5 or 4, somewhere real early on in the process of the Apartment Guys podcast. But so you're actually our first returning guest, Paul.
I am honored.
You should be. No, I'm kidding. That's great to have you back. So when we get started in commercial real estate, multifamily real estate, buying apartments, sometimes you hear from different gurus selling the benefits of this commercial multifamily space, that it's just the property that qualifies for the financing. In other words, if you have a good deal, the money will come. You hear stuff like that a lot. You hear people say that unlike single family, commercial multifamily isn't as much about the borrower as it is about the asset. You hear stuff like that said a lot. And that's not really the whole truth, is it, Paul?
No, it's not. It's not an outright lie, but it's a bit of a half truth. And the quick answer would be, yeah, if you want to pay 12% interest, then sure, the asset or the property will be fine. That's all you need. But in fact, I was at a networking event just today, commercial real estate investors, and I had this conversation 2 times. So really the focus of what I want to share today with the group is really those beginning stages as we're making that transition into commercial real estate. What does commercial financing look like? What can we do to prepare and make it as smooth and easy as possible, and make you aware of some of the pitfalls? So put together some slides. There's 12 points that we'll go through, and we could take deep dives on any. Please interject if anything isn't clear, but we'll run through these and get people locked and loaded for their intro and their first
Sure. Sounds great. Yeah. So where do we start?
All right. Well, let me just get this going here. Let's share my screen and we'll jump in.
Yeah.
So this is a bit of an odd one here, is the first thing to talk about, an organizational chart. And really, when we're underwriting a deal, we really want to understand who's borrowing the money and who the guarantors are going to be. And this is a document that I always get when I'm putting together a loan package, but not necessarily the first thing. It usually comes later on, and it can be a bit of a moving target, but it's worth talking about because it really makes it simple for lenders to know, hey, who's going to be borrowing the money, who's going to be signing on the dotted line, who owns what. And so really it's a simple document. We've all seen org charts in business throughout, but really in commercial real estate, your business is the asset. and you're borrowing as a business entity. So there should be an organization chart showing who the ownership is and what percentage they own, and ultimately down to that warm body or that guarantor of the loan. And so it's something that can be a little bit of a moving target as you go through the process, because sometimes partners change or things evolve, but it really is something that will simplify the process and wrap your head around who's doing what, and it helps you get started in the process of setting up the business and getting the right documentation in place. We'll always need a operating agreement, articles of organization, and an EIN to do the loan. And so this helps get us on the right path.
And you have noted here that anyone with 20% or more ownership in the deal is going to be required to sign on the loan docs and or guarantee the loan.
Right. And so again, that's something, if you have partners that don't want to be on the loan or don't want any exposure in that way, make sure they have less than 20% ownership. Or if you do have 20% ownership, you're going to plan on signing on the loan.
Mm-hmm, mm-hmm. Okay, great.
Thanks for pointing that out.
Yeah, great.
So the next thing that's easy, and it's a great document to have on hand, it's your personal financial statement. And this is really the sum of all your assets minus your liabilities. This includes your personal residence, any retirement accounts, cars, homes, investments, the whole 9 yards. It's really your own personal balance sheet. And this shows what your net worth is. And that's a question we'll ask in the underwriting process. What's the net worth of the borrower? A common metric is that the net worth of the individual or individuals borrowing or guaranteeing rather should be a 1-to-1 ratio of net worth to loan amount. And so this personal financial statement is how we show that to the lenders. Mm-hmm. And so the other component or other question that gets asked a lot is what's the liquid assets or the liquidity of the guarantors. A good rule of thumb is if you have 10% liquid assets post-close or post-equity injection, then there's no problems qualifying for the loan.
Okay,
so my recommendation,
go ahead, Paul,
is to keep 10 to 20% of net worth in liquid assets. And that might seem extreme. We're in real estate because we love real estate. We want to deploy that capital. But especially as we get into syndication, it's our job and our responsibility to be able to qualify for the loans
right.
that we're putting together. The equity's coming from investors, right? And so having a large portion of your portfolio in liquid assets really can help you get more loans. And so it doesn't have to sit in cash. We're all worried about inflation these days. And so cash isn't necessarily a great place for a return or a savings account, but stocks, bonds, cryptocurrency, whole life policies have a cash value. All that counts as liquid assets. Retirement accounts don't. So if you're in an IRA or 401k, that contributes to your net worth, but not to your liquid assets.
So just to be clear, the general partnership, so the conglomeration of partners that are doing the deal essentially has to have a net worth equal to the loan amount and a liquidity amount equal to, after equity injection into the deal, a liquidity amount of 10% of the loan amount.
Yeah. And those are, some loans have that spelled out. There's no wiggle room. Other loans, it's not so hard and fast. But that's a good general rule of thumb. I've found that if you meet that criteria, there's very few loans that you wouldn't be able to qualify for.
Mm-hmm. Got it. Great.
Something that goes hand in glove with your personal financial statement is your schedule of real estate. And that details all the real estate that you own, including your personal residence. So any investment properties or could even be vacation homes. You want to detail out what real estate you own. And in the template I give out to clients, there's a separate tab. It's an Excel file, and there's multiple tabs, and there's a tab for the personal financial statement data, and then there's a tab for the schedule of real estate owned, and that's where you include the property address, the mortgage balance, the net operating income, any payments if there's debt on it. It shows equity, and it can show a global cash flow from your real estate investments. And so we're in real estate, we want to show experience in real estate, and the schedule of real estate is that document that works together with the personal financial statement to show that. And so you will populate a couple line items in your personal financial statement from your schedule of real estate owned. And you really do want them to work together. It can be a bit of a red flag, or at least cause you some more work or explanation if the real estate totals on your personal financial statement are different than the schedule of real estate owned. And so it's best to just have it all in one spreadsheet, or make sure those documents reflect accurately exactly the same information. That's great. That's a little tip there. I've certainly come across that where the numbers don't match, and we've got to solve that riddle.
Yep. Something ain't right there. All right. Gotcha.
All right.
Next one.
Number 4 is a bio or resume. And, the resume can be a bit of a daunting word. We think of job, resumes for a job application, and every comma and period and formatting has to be perfect. That's not what we're talking about here. It's really a way for you to talk about your success in the past, your relevant skill set. It doesn't have to be a real formal document. Not that it's a bad thing. If it is, a presentation can help. As you go through the underwriting process in a commercial loan, there are multiple layers. On the front end, as a mortgage broker, we're gathering information, we're assembling it, we're sharing that with multiple lenders. Once we choose a lender, it goes through their channels and analysts and underwriters and loan committees and approval. So there's a lot of people that look at any given loan application and through the process. And let's say you've exited 3 or 4 or 10 deals for that matter. It could just be one, but maybe you've had a flipping business where you've flipped 50 single family homes. Well, that's not going to show up on your personal financial statement or your schedule of real estate owned. But we want to convey that information, because that experience really is a mitigant to risk that lenders may perceive. So that resume or bio is a document that can share your experience. You can capture all the real estate you've ever been involved with that may not, continue to show up on your schedule of real estate. So these 3 documents, the PFS, the SREO, and the resume, are documents that will take a little bit of time and effort to put together the first time. Somewhat of an investment, I'll say. But after that, it's really easy to update those on like a quarterly basis. I'm not perfect at this, but I try to make a habit of it personally, for my own investment purposes, to update those things. And once you start keeping track of it, it's fun to see it grow as well. It's a bit of a scorecard, and that's just an added benefit of doing this. But being aware of where you've been and where you are, can be a bit of a motivator as well to keep going, and also to celebrate some of your successes as well. So it's something we're always going to ask for. And I know it can feel a little bit like homework, but once you've got the core documents, they're fairly easy to update. And then you don't have to worry about it when you find that deal. You can focus on the deal and not some of these ancillary items.
Right.
Another thing that's great to just stay on top of is your tax returns. Not all loans that we source will require tax returns. Most bank and credit unions will want to see 3 years worth of tax returns, and that's all your personal and business tax returns, including all K-1s. And so it's really pretty simple to create a Dropbox folder, some online file share platform. You take 15, 20 minutes, you put everything together, and then you know where it is. And then you can easily, when that's requested, you don't even have to email them. Sometimes the files are larger. You can just share a link to that. It can be password protected, so it's secure. But that way, it's really easy to share that information, and just a good practice to keep all these tax returns in one place. And then on top of that, I know a lot of people do extensions. I'm not saying that's a bad thing, but if you can file, I would recommend that. It's just, it makes it easier. It's not like you can get around it. So let's say you file an extension, you're in the process of a loan, maybe June, you filed an extension, you're going to file in September. The lender's still going to require, like an updated balance sheet and financials from the businesses. So the tax return is a common format for underwriting. So again, if you're able to and can do it in a timely manner, I definitely recommend that. And then just a bit of a PS to this. Again, I understand we're in real estate. I'm the first to say, hey, the least amount of tax I can pay, the better. But lenders are looking for income on tax returns when they're doing their underwriting. So if there's nothing to be shown there, it may be harder to get a loan. I'm not saying it can't be done, but we've had some hiccups, and we've had to pull in different partners when this is the case. And so it's not financial advice. I'm not your CPA. I leave that up to everyone. But if you can show a little income on your tax returns, it's not going to hurt in the underwriting process when you're working on a commercial loan.
Okay, so you don't want to write off everything. That's what you're saying.
It's a fine line, and that's really a conversation for your CPA.
Sure.
I hesitate to
well played.
to provide blanket advice, but I've just had feedback from lenders where someone does show a lot of income. They're like, "Oh, that was easy to get that approved." So there's a confluence of things that go into the decision, but that's just something that can help, but not entirely mission critical. And again, some loans, like when we get into the agency loans, Fannie, Freddie, CMBS, we don't even require tax returns. It's really more of a bank, credit union type loan where we need the tax returns. So, but we all got to file them, so it's good to have them put together in a easily accessible space where you can share those easily. It just can speed things up.
Gotcha. Perfect.
And then credit score. Again, unlike residential lending, we're not that focused on a credit score or your credit report, but it is something we pull for every guarantor on a loan. And we want to see that credit score is 680 or above. If you come in at 800, you're not going to get a better rate like you will with a residential loan, but it's more of a threshold rite of passage. We're looking for any bankruptcies or foreclosures. Those are major red flags. We need a letter of explanation for those. Again, life happens, but it's best to do everything you can to avoid these scenarios, especially if you're going to be active in real estate. And if you've got any delinquencies, judgments, outstanding items out there, resolve them. It can be somewhat, I'll say, interesting if someone's trying to borrow $3, $4, $5 million and they've got a $15,000 judgment on there. It's like, hey, what message are we sending here? So again, keep a clean credit report, pay any outstanding debts or items, even if it's a couple years stale. It's better to handle that and not have, not get to a closing table and have someone on a loan committee not like that blemish on your credit and have it kill a deal. It's just good to be proactive and keep your credit clean and as strong as possible.
Yeah, on things like bankruptcies and foreclosures, Paul, are those like, I mean, it used to be like these things would come off your record or whatever. It's at a certain point in time. I kind of get the feeling that more recently, it's like not really, like those things kind of stay with you, huh?
Yeah, and that's where it's hard to give an exact answer because, again, different credit bureaus are going to keep things on for a little longer. Mm-hmm. I don't know all their protocol. Different things can stay on for a different matter of time, and one credit bureau might still be reporting it and another might not. We haven't had a lot of economic turbulence, so a lot of the fallout from 2008, 9, 10, a lot of that's burned off and not necessarily showing up. Mm-hmm. 7 years is a pretty good rule of thumb. So I've been working on a loan where it was a 2013 bankruptcy and it did show up, and it was probably a couple months before it would have burned off. So it was a little unfortunate timing for that individual. But, we can work through those things. Like I said, letters of explanation help, doing everything you can to mitigate those losses. And, like I said, life happens, but even if they're on there, we can work with them. We just want to have a strong explanation.
Sure.
Behind it.
Great. Okay.
So those are that's really the credit side. So if we're looking at the borrower credit package, as I'll refer to it, those are the items that we're looking at and that need to be on your radar. And those are things you can work on before you have a deal. And it may sound like homework, but it's really preparation. By getting these things in line, you're going to have to address them when you're doing a deal. And if you can have basically everything put together, you may need to update a couple things. It's going to make your life easier or simpler than trying to, file a tax return before you can, qualify for a loan or something like that. It's just, it'll smooth things up as you go through the process. Mm-hmm. And then to come back to your initial question, the property also needs to qualify as well. And so we'll talk more of property specific items as we move forward. Pretty simple, but you'd be surprised. I get calls and people will say, "Hey, I want a loan," and you gotta pull some information out of them. So address, unit mix. The unit mix is, bedrooms, bathrooms. Is it 1 1s, 2 1s, 3 1s, meaning 3 bed, 1 bath? Just good to understand that. Certainly a unit count is useful. A date built and a date renovated. What is it? What does it look like? So photos photos worth 1,000 words. That'll tell you the style and condition pretty quickly. Just some basic property information is a great place to start, and just to have handy when you're talking to a lender or mortgage broker when you start the process.
Yeah, one thing to point out here, Paul, and just to interject is,
sure,
we're about 6 items into what you need as a lender to make a file work and to get a transaction going. And you just now mentioned the actual property for the first time, which is pretty telling. Tells a lot about what a lender is looking for, and the lender is indeed looking at very, very significantly at the borrower, obviously.
Yeah.
So yeah,
and really, if you can provide that information, it's a pretty quick process and underwrite to get through that, right? But that really says, hey, this borrower or borrowing group of individuals is eligible or worthy of the credit. And if they're not, none of the property information really matters. That said, certainly done deals or partnerships have been formed midstream in order to make things work. That can be done. We can backfill that, but it's just so much easier if we know everything up front.
Mm-hmm.
But yeah, it's a little counterintuitive, but when you're starting out, especially with some of those rumors we've talked about floating around in the ethos about, oh, it's just the property. Well, there's more to it than that. But continuing on with what we want to know about the property, and I would say generally lenders are very good about knowing markets and understanding markets. That said, there's literally thousands of submarkets across the United States, so you can't keep your pulse on everything. Generally, it's easier to get loans done where there's more population, there's more economic diversity and opportunity and renters or tenants. So we can do deals in very rural areas, but again, more urban makes it easier. So understanding, hey, what is the population of this market or MSA? What's desirable about it? What are economic drivers? Is there economic diversity? Who are the major employers? Is there growth in this market? Lenders are good at accessing this information, but through your due diligence, if you have it on the tip of your tongue and can share that easily, it's only going to help your cause and speed up the process. All right, now we're getting into the documents, and not all owners or sellers are as good at keeping records as others. I laugh. Right. I chuckle a little bit because what I've seen is people are getting into commercial real estate. A lot of time their sellers that they're working with are fairly unsophisticated mom and pop type shops. They may self-manage and they don't necessarily keep good records. Most property managers are very good at keeping a good rent roll, and this is what we want to see and what we're looking for with the rent roll, but it should include the tenant name, their move-in date, lease expiration, monthly rent, other income, deposit. So, those dates are helpful to see how long people stay, if there's any seasonality in lease up, or if there's a lot of people potentially leaving at one given time. It's good information for you to understand as a buyer or an owner as well, just to those are really your clients. That's your income. And so it's good to have a bead on who these people are and what, they're paying for to occupy these units. The rent roll is going to show a physical occupancy. That's the obvious number to calculate. You say, oh, there's 10 units, 9 of them are occupied, and that's 90% occupied. We definitely, for most loans, want to see at least 90% occupancy. I'd say I'd qualify that for permanent loans. It's obviously different on construction or bridge loans when there's a value add opportunity. But we'll look at that. And then it also helps us understand economic occupancy. That might be a harder term, or a new term, I should say, for someone starting out in the business. But that economic occupancy is, okay, we may have 90% of these units full, or we may have 100% full, but what are we actually collecting? If we have a 10-unit building and there's 10 tenants on the rent roll, but we're only collecting 80% of the income as per the rent roll, then we've got a economic vacancy of 20%. Our economic occupancy is only 80%. And so once we compare the rent roll to the income statement, we can start to understand economic occupancy. We'll talk a little more about the P&L here next, but that's an important factor. We not only do we want tenants, we want tenants that are actually paying their rent on a monthly basis. We can also check for a military concentration or a student concentration. lot of people will come to me and say, "Oh, it's next to a military base, or it's in this there's a lot of students. There's this school in town." Well, a lot of people see that as a positive, but from a lending standpoint, those are typically negatives. The reason being, we want economic diversity among the tenant base. We don't want a single military base or a school to control the viability of the profit of the property. So a military base closes down, a university decides not to hold class because of a pandemic. All of a sudden, all your tenants leave. It's not a very diverse situation. So that's just something to be aware of, to have on your radar. Again, they're not deal killers. They're student specific or student housing loans, I should say. But that's something to be aware of, and it will be asked if there's potential for a high concentration of those groups. I mentioned the P&L, the profit and loss statement. You'll also hear it referred to as an operating statement or income statement. It has many names, but all of them work. They're all synonymous. We really want a trailing 12. You'll hear the term T12. That's kind of industry speak, if you will. Mm-hmm. But it's a trailing 12 months. And so what that means, if we were looking at an annual P&L for 2020, for example, the trailing 12 on that would be each month broken out individually. This allows us to see any seasonality, if there's more expense or more income or more occupancy in different months. Usually it's pretty smooth, but it's just helpful to see how that works. And especially the most recent, like trailing T3, you'll hear some loans will size or base the loan amounts on the most recent 3 months. So again, most property managers can have software that will easily configure that, and some mom and pops may not be that sophisticated, and we work with that. But ideally, we have a trailing 12-month income statement to see what the property's done in reality over the last year. It's also helpful to have annual P&Ls for the previous 2 or 3 years. We want to make sure that it includes taxes and insurance. That's property taxes and property insurance as line items. Sometimes those are escrowed and part of a mortgage payment, so they don't find their way to the P&L. And it might make things look a little rosier than they are. Those are things that we'll look for real quick and identify, but it's something you can keep your eye open for as well, to make sure there's a line item for property taxes and property insurance. And there's a couple of things we don't want to see on the P&L that's going to hurt, because we're ultimately trying to get to a net operating income, or NOI, through the P&L. And if there's mortgage payment, interest expense, or depreciation, all those things should not be included in the P&L or the operating statement for the property, because they're going to be different for every owner. They're not necessarily standard, and so that doesn't affect the true net operating income, which is used for valuation and cash flow purposes. So again, just a couple things to have on your radar to keep in mind, to either include or exclude from the P&L.
Mm-hmm. Gotcha.
Then we want to see where you're going. So we'll call it a budget or pro forma. Typically, we're looking for a full year after stabilized, or after you're stabilized. So if you're doing a value add play, let's say you acquire a property with a bridge loan, or you're doing a construction loan, we'll want to see, okay, once you get it all leased up and you're at least 90% occupied, what are your projected operations? What's the income going to be? What are the expenses? What's that projected net operating income? Most property managers can help put this together. That's probably something you're doing with your analysis as well. It's a fairly common request, that it's not necessarily something that a lot of folks proactively have available, even though they've done it mentally as they're analyzing properties. It's just a good practice to have that handy. It shows you know what you're doing, you're sophisticated, and your vision for the property, and that's a great way to share that. And then it's great to have an idea who your team is, or your supporting cast, if you will. And a lot of times you're doing due diligence, you're interviewing property managers or sourcing insurance quotes, that sort of thing. But again, if you can do that proactively, if you know the market you're going to be investing in, going into a deal, if you know who your property manager is going to be, if you've got a contact for insurance, you've got a relationship with a legal counsel to help set up your business entity, your operating agreements, review loan documents, and then if you're doing any value add or new construction, having your general contractor lined up is going to help. So those are, I'd say those are nice to haves. They're not entirely necessary on the onset, but you'll certainly need insurance and legal to close the loan. And most lenders want to know who the property manager is, going in. So these are just things to have on your radar. I know it's been, I made a lot of suggestions, a lot of things to be aware of and have on your radar. It's not to overwhelm. It's simply to help you prepare, and also, give an overview of, hey, these are the things that are going to make the process smoother, more effective, and get you better terms on your loan. All right.
So just to summarize here, we've got 12 things that we need to be game ready to get a loan with Paul, and Paul's here to help you get a loan. So by all means, reach out to Paul at Bonneville Multifamily or Multifamily Capital. Hey, Paul, how can people reach you? Yeah.
I should have a slide with that information. I apologize.
That's okay.
I don't have that. Email is probably the easiest. I'll also give a phone number as well. But my email is Paul, Paul, at BMF CAP. So Bonneville Multifamily Cap .com. And my office line is 801-323-1050.
Awesome. Great. And then just to summarize, guys, you need an organizational chart, personal financial statement, schedule of real estate owned. You need a bio and a resume, tax returns, credit score, and your credit report. Those are all the personal things you need. Related to the property, you need the property information, market information. You need a rent roll. You need a budget and pro forma, and you need a supporting cast and team member list and description. So there you go, guys. Expert from the mouth of Paul Winterowd, lending expert, bringing you the 12 things you need to do to get game ready for getting a loan in multifamily. Thank you, Paul. Appreciate it.
Yeah, my pleasure.
This was great. All right, everybody. Thanks for listening to another episode of The Apartment Guys. We're going to have Paul back on another episode here real soon to go through some other kind of tips on getting the loan, right? On getting the debt piece in place for your purchase. So with that, we'll see you on the next episode.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.